Well, good morning or good afternoon, everyone. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. I am a coach with Charles Schwab. And as Will said in the chat, happy Monday and let's go. So we have a lot to cover today, as we always do in this class. I hope everyone who celebrates Easter enjoyed this past holiday weekend. I know it was jam-packed for me and many others. Today is going to be brought to you by the numbers 1, 2, and 4. So we have one trade that hit a target this morning, one that should have hit a target had we put the target in. So we have 2 trades to manage and then at least 4 new trades to place. So this is a very active trading account. We place a lot of example trades and then we follow up on those trades in this class. And sometimes when a lot of trades hit targets, I will do a trade management mini session to go over the details. And I did one of those. It was posted last week, and I'll show you where you can find that if you haven't seen it already. We have Kevin Horner with us in the chat. He's a friend and a fellow coach. He understands all the strategies we're going to talk about today. We're going to talk about at least 3 or 4 different strategies, with the trades we're placing, probably actually more than that. And so the understanding in this class is that you have a basic idea of what these strategies are about. If you are brand new to all of this, this class can be a wee bit like drinking out of a fire hose in the beginning, but keep coming back. The more you come back, the easier it gets. Okay, so if you are not following me on X, I invite you to do so. My handle at Barb Armstrong CS. Kevin Horner is at Kevin Horner CS. We're both posting content on a daily basis, and it's a way for us to be able to communicate with you outside of events like this. Just a quick reminder that options carry a high level of risk and aren't suitable for all investors. You have to apply for option trading privileges if you're a client of Schwab, and not all will necessarily qualify. We use the Paper Money software application on the Thinkorswim desktop platform, which is a brilliant place to learn, hone your skills, make sure you understand how to place the trades you want to place on the platform, and make sure that you understand your trading strategies before you consider trading in a live account. There are some nuances and differences, which I'll point out as we go, but the biggest one for this class is that short option positions will never be assigned early in Paper Money. That can happen in a live account. Okay, so let's get over to the Thinkorswim platform. If we bring up our S&P 500 index, the SPX, we're seeing a bit of a diagonal resistance breakout here. But, I don't think that Chicken Little has, gone into hibernation yet. There are some that might look at this and say, this could still be, a downtrending. And the jury is still out. There's still a lot of political uncertainty with what's going on with the Strait of Hormuz. And so people are proceeding cautiously. But so far, we've had 4 up days, and we haven't seen 4 of those in a row for quite some time. So things feel a little lighter and brighter, perhaps, in the market today. The NASDAQ, again, 4th up day, up, 0.38%, like not just shy of 0.5%. And some might be looking at this and seeing a bit of a diagonal resistance breakout, but we're still well below the 30. We're well below the 100-day moving average. And if we back things out a bit, we've been in a sideways range here since October, and we broke below that recently, and we've just kind of crawled back above this ledge. And so, there might be a little cautious optimism, but, yeah, we're not bringing out the bathing suits yet. When we look at our small caps, it's similar, isn't it? We've had this pullback, and, like, this is not nothing. I've got to draw it the other way for this to get to see this number. Down 12% off the highs. there's a reason, that people were saying, we were like officially on the NASDAQ and the S&P, in correction territory. And, for more detail on this, Kevin Horner does a really fantastic class called Trader Talks 4 days a week. And this day was one of them. So you can go back and catch that in the archives. Okay. So, but it's interesting, but because we've had these 4 bullish days in a row, when I was looking for example trades today, I saw a lot more bullish opportunities than I saw bearish opportunities that were complete setups. And that isn't to say that there aren't still a lot of bearish things perhaps happening, but if we look at, say, Disney today, now this has been downtrending. It hit its high back in June of last year. And, since the beginning of this year, it has pretty much been rolling down a hill. Like Humpty Dumpty is in the hood. But if we come up and we look at this, do we have an entry on this today? Do we have a close below the low of the high day? Well, some might say, we're flirting with it. If we look at this as the high day, because we are trading below. But so I could potentially add this to my list for a bearish example setup. But there's a lot that are, there's a setup happening, but it isn't complete. We don't have that close below the low of the high day yet, or whatever it is that your entry might be that you're looking for. Okay. Okay. So the last thing I wanted to look at here was the VIX. And our VIX is now at 24. We're going, whoa, that's come down a lot. Well, yeah, maybe. But I mean, it's still pretty high. Like if we draw a line here, one sec, let me get my drawing tool situated. This is where it is now. Like there aren't a lot of times we have been this high. We're still pretty high compared to where we have historically been. So what this means is maybe selling, if we're looking at an option, might have some appeal, or just a simple recognition that if we're buying, if we're buying an option, even though volatility has come down, it's still, we're not looking at bargain basement prices here. So we've got to be aware of that also. Now we had one trade that hit a target today, that was Tesla. And if we come and we look at Tesla, so this is our one. We had put a long put vertical trade on Tesla back here on the 27th. So I think that was last Monday, or sorry, it was a week ago Friday. So we put this trade on with the expectation that this stock might continue to fall. Our strikes were at 370 and 365. So we wanted it to go below 365. And the expectation was that it might stay there. We put in a target to exit at a 50% gain, and it hit that target today. So if we come to the account statement and we look at Tesla, I'll just change this to 20 days, because we've done a couple of these, and this is not uncommon, for us to do a wash, rinse, repeat. But in this particular case, we bought this vertical, which means, when we buy something, what are we risking? We could lose the entire amount. So here we bought this for $240. So we were risking $240 a contract. We did 2 of them. So we had $480 at risk. In this class, our max risk per position is in that neighborhood of 500. Sometimes we might go as high as 540 or 550, but we're not going to go 6. And then our target was to get out with a 50% gain. And so, if we just look at the math on this, 360 minus 240, we made $1.20 a contract times 2 contracts times 100. So in total, we made $240 on this. And, $240 we consider, a base hit in this class. We started the year at 25,000. We're now at just over 31, but 24 is just shy of 1% of the total account value. And our goal in this class was to make $100 a week. And given that the account is now, we've essentially done that. For the year, our goal is to make 200 a week on average over the course of the year. Now, what the market giveth, the market can taketh away, and we all know that. But we're in this class, we're looking for little wins and base hits, and we tend to tightly manage things. So 240, and if we're looking for our return on risk, we made $1.20. We were on a 240 investment, so our return on our risk was 50%. Now, one of the things that we've done lately is we've said, because there's so much volatility and uncertainty in the market, maybe we don't go for the 50% gain. Maybe we just go for 25. So we've put in a number of trades with a smaller target on a long put vertical or a long call vertical. So, sometimes in paper money, something will hit a target and exit faster than it might in a live account. So if you have a trade similar to this in a live account, you might want to look at it and just see where the numbers are. As maybe if you're at, say, 45%, you might say, hey, that's good enough. Now, AMD, I don't know why we don't have an exit on this, but we don't have a little chiclet. So when I see that I don't have a little chiclet, which indicates, like I have here, an exit order, the first thing I do is come up and look at working orders and see if maybe it's somewhere else. And so these are I just clicked symbol to order them alphabetically. So we have no exit in place for AMD. Somebody dropped the ball. I don't know who, but I have a feeling it was me, since I'm the only one that puts these orders in. And our goal in our example trading plan with short put verticals is when we have 80% of our max gain, we're going to exit that position, and we're at 80.3. So if we want to see this on the chart, we had our short put vertical trade here, and this is where it's now sitting, and we've got this inverted hammer. So, this may not last, my friends. This could come back down, and, this expires April 17th. So we are going to right click on that. We are going to create a closing order to buy this back to close it out. Okay, so confirm and send. Done. Now, I said it was 1, 2. This was sponsored by 1, 2, and 4. The 1 was Tesla. The 2 was AMD. And we had also done a trade on UNH. And we had put an iron condor on. So let's come and look at UNH. And then after this, we'll look at new trades. So let's come in a little closer time frame wise. So with this one, here are our strikes. We did a short call vertical up here where we wanted it to stay below 295. That was our expectation, is that this UNH would continue to trade below 295 and above 265. So when it came down close to the support level, we closed out this side of the trade. Excuse me. And so if we come in and we look at now UNH, we saw that we placed this iron condor trade on the 20th. On March 30th, we bought back the call side. We closed it out and we took our profit. So we were paid $2.50 in total to enter this iron condor trade. We paid 34 cents to close out this side. Now, when we look at the chart, it's heading for this long call side, but because volatility has continued to stay so high, we're still in that trade. And also, when we had put in a single exit to exit the trade all 4 legs at once, and when we closed out the short side, we didn't go in and re-put in a target a profit target to close out this side. So if we got out now, we'd have to pay almost, we'd have to pay $94 to close this out. But it's, as long as it stays above 265, we're $17 above that right now. This should decay. It expires Friday. So some people might say, my rule is that the Monday before expiration, I close it out no matter what. Others might say, well, you know what? With where this is, I'm going to look at this again tomorrow and Wednesday. And I mean, worst case is we close it out Friday. The problem with closing things out on the day of expiration is that if the trade has gone against you, it can be difficult to get it closed out. And sometimes you have to close it out a leg at a time. But what we're going to do now is just create this closing order and say, hey, when this is worth about 20 cents, so we'd have 90% of our max gain, we'd like to exit this so that we've got that exit in place. And if it moves up again tomorrow, along with, time decay and the fact that it's approaching expiration, hopefully we'll get closer to our target. If not, if it looks like it's going to start pulling back, we could just go in and close it out. Okay. So earnings is coming up on the 21st for UNH, but this trade expires in 4 days. We put in a trade that we would be out of prior to expiration. Okay. Okay. So now with KMI, we did a buy right, and this isn't the first call we've sold. We've sold calls before this, but we sold this call for 67 cents. It's now worth 8 cents. So, if you take a look at what's 8 divided by 67, we've got 89% of our max gain on this. So if we come and look at KMI, where it's sitting at a support level, and we have this covered call that expires April 17th. If this were to bounce, and given that this is at a support level now, from a technical perspective, were we to want to place a bullish trade on this, we'd want to wait for confirmation. But we might say, well, if the expectation is that this support level might hold, maybe what we want to do is buy back this covered call. And when it comes back up close to this 34 level, then we could sell another one. Okay. So we are going to, to do this, we have a position to exit KMI at what price? At 31.82. So KMI, our stop is at 31.82. And that stop includes buying back the covered call and selling the stock. But if we want to buy back the covered call and not exit the position, we're just going to cancel this order. So we're going to cancel that order so that now I can come in and create a closing order to just buy back that covered call at the support level with the intention of selling the next covered call when it gets up closer to resistance. Okay, so once that fills, then we can go back in. So now that it's filled, now we can come back in and say, okay, now we want to put a stop on KMI, and our stop is at 31.82. And we're not going to change that at this point. I'm going to make that good till canceled. Okay, so that's our trade management for today. Let's go and look at some new opportunities now. And let's start with APA. So APA Corp. Now, if you're not familiar with this company, you may be kicking yourself in the tuchus this morning because this is a stock. It's up like 74% year to date. Like, holy smokes, Batman. Like, that's incredible. And it's in that value category because the PE ratio on this is at 12%. Now, you can also see this on the trade tab. If you come, when you see where your price is here, if you click this little arrow, it'll say, okay, and this is why scripts are not guaranteed as to accuracy. This is saying your PE here is 10.6. So it's considered to be a value stock. It pays a dividend. Now, one of the differences between paper money and a live account is that dividends aren't actually paid in paper money. And we're not doing this because it pays a dividend. But this might be part of the reason, part of the appeal is that, it's considered to be a value stock, pays a dividend. If we come to the Analyze tab, we can see it's also an energy stock. And energy has been like hot when the rest of the market has been not. So could we look at APA, which also happens to be trading at 42.62? So if we look at that and we say, well, a recent high here was $45. What if we came out to the trade tab and we said, you know what? This is only 2 weeks away. What if I sold a covered call on this? And so I'm buying the stock and I'm selling a call. Or I could come out to May and here in, this 45 strike, I'd get 76 cents and this expires in 11 days, as opposed to I could get $2.14. But, then we're in this for 39 days. And so could we kind of approach it with I'm going to come in, I'm going to sell this call that expires in 11 days. And if I get called out, well, I get called out. And I'm okay with that as long as I make enough money. Well, how much could I make? If I don't get called out, I get to keep this premium, right? If it doesn't go up to $45 a share in 11 days, I get to keep this premium. And then I could come out here and I might get a little bit less, but maybe I'll get over $1. And then I could sell the May. So these are some of the thoughts that might be going through a trader's mind as they're considering placing a trade. Okay. So we're going to look at this and say, well, if I bought, and in the parlance of Thinkorswim, they call that buying covered stock. So if I look at this, I say, okay, I'm getting in for $41.75. The most I can make on this is $45. If it goes up to 50, I'm going to get called out at 45. So the most I can make on this is $3.25, 45 minus 41.75. So I am going to change this to a calculator and say, well, if I could make $3.25 a share on an investment of $41.76, it's not going to be 10%, but it's going to be more than 5. It's going to be 7.8%. Like, that's not too shabby for a trade that you're in for 11 days. Now, this trade could also go sideways or it could go wrong. And, so where might we put our stop? Well, if we take a look at a recent low, and I already did the math on this. So if I said, well, if I come in and look at this and looked at this recent low of 40.37, and I put a stop 3% below that, that would be at 39.16. So if I come back here and I say, okay, 39.16, I'm risking about $2.50 a share. Am I okay with that? Well, we can risk up to $500, and we can also invest up to $5,000. So we've honored both of those position sizing rules. So I'm going to come to single order. I'm going to change it to first trigger sequence. I'm going to right click, create an opposite order. I'm going to make it a market order that's good till canceled. Click my disappearing, reappearing sprocket. I'm going to say, hey, if APA goes at or below 39.16, we want to shut her down. 39.16. So we're placing this trade. We're trying to manage the potential damage to the downside. There's never a guarantee. If this were to gap down, we could end up losing more. And we're looking for a base hit. And, most in this account, like this is over 1% of our starting account value. We're going to call that a double if we're able to pull it off. So this is a covered call. So we're buying the stock and selling the call at the same time. It's called a buy right covered call. And so we're going to put that in the bucket. We're investing $4,178. Now this says max loss $41.78. It's because it doesn't take this order into account. And this is if the stock went to zero in the next 11 days. Now, I'm not saying nothing is impossible, but it's highly unlikely. Yeah. Okay, so that's new trade number one, APA. So let's go over now to a stock that's, and again, this might be one where you're going like, hello, like this little guy's Nebius Group, this is up 35% year to date. Like, now keep in mind, like our SPX, which many would use as a benchmark, is down 3.5%. So if you just bought this stock and held, you'd be crushing it if your goal was to beat the benchmark. But when we look at this, you're going, it's up 35% year to date. Like seriously, like this has been it's almost like a sideways cup and handle, but it broke out, came back to retest this diagonal resistance level, which appears now to be acting as support and is moving again to the upside. And so could we do a long call vertical with this? Now we could do a long call vertical. And the advantage of a long call vertical over buying stock is that it requires less capital and we're defining our risk. So there's kind of lots of benefits. If we look at doing, say, buying a call and doing a 1 ATR target, we're likely to be in or out quicklier. Oh, Lord, it's a Monday. We're likely to be in or out faster, but if it pulls back and this stock, like this is $113 stock, and the ATR on this over the last 14 days, so average true range, this means from high to low of the day is $9. Like that's not a 10% swing, but it's a big swing. Like this is a lot of movement in a day for $100 stock, a $9 range. That's got to be 7%. Yeah, I make up new vocabulary every once in a while, Chris. So, but so if we look at this and we say, well, if we do a long call vertical, might that give us a little bit more flexibility if it were, to move down, then we don't get nicked out. Okay. So, and the next question we have to ask is, well, how much does this trade? What sector are you familiar with this? It's part of the tech sector. Okay. This is an ADR company. So it's based in Amsterdam. And so with ADRs, like, how do we know that? Well, it says right here that it's based in, and so that can have, additional risks that American-based companies don't necessarily have, currency risk and all that good stuff. So we need to be aware of that, right? So they have formed a strategic alliance with NVIDIA. Many of us may have heard of a little company called NVIDIA, founded in 1989. So, that just gives us a bit, of a marker. And this is 5-year trend. So it went from losing money in 2024 to being profitable in 2025. Over 108% return year over year. But this stock has more risk. Now, when we come to the trade tab, if we look at this, one of our example trading plan for a long call vertical would say, does this trade more than 1 million shares a day? Check. do we have at least 20 times the number of contracts we want to trade here? And you know what, we're going to come out more than 11 days. If we come out to May, it gives us more time. So we have thousands of contracts. This is very heavily traded. And yet still we have a like 40-cent bid-ask spread, but on a $14 contract, we're okay with that. You know, because we're saying we want the bid-ask spread to be less than 10%. So we're going to come in here and say, okay, what if we buy a vertical? What are we paying for that? And when we buy a vertical, what we want is for it to go through both strikes and then stay above both strikes. So if we're at 245 and we say, okay, we want a 50% return, 245 times 1.5, when this is worth 367, we'd like to exit. And some people might be saying, like, are you new? Like, what are you doing? Because we could make more than 100% return. We could lose 243, but we could make 257. And to that I say, yeah, that used to be my strategy and it almost never worked out. You know, and so we're just going to try not to be greedy. And if you were at Easter dinner yesterday and you said, like, can you believe this crazy woman suggested that I place a trade and get out with a meager 50% return on a trade I'm not going to be in for more than 45 days? You know, they would probably throw a roll at you. So yeah, we're going to go with this. 367 is going to be our target. So I'm going to change this to first trigger sequence. How many contracts can we do? We can do 2. And we're risking, you know, 490. Is that less than 5? It is. So we're good to go. We're going to right click, opposite order, 367. Oh, well, this is 375 at 250. Good till canceled. Fire in the hole. Okay, long call verticals. So what have we done so far? We've done trade management on an iron condor. We exited a short put vertical. We reviewed a long put vertical trade that had hit a target. So that was 3 different types of trades. And then so far we've done a buy right on APA where we bought the stock and sold a covered call. And then with Cisco, this was NBIS. We haven't done Cisco yet. Spoiler alert, Cisco coming up. NBIS, we did a long call vertical. So we've looked at like 5 different trading strategies already, and we've got like 10 minutes left. Yay us. We are rocking today. Okay, so let's see. Let's look at Cisco. What's cooking with Cisco? Okay, so Cisco, you know, it's up a modest 3.4%. So still like outperforming, you know, all the major indices, right? And if you're not familiar with Cisco, again, come to the Analyze tab, based in San Jose. Do you know the way to San Jose? Yeah, and it's a tech stock. Okay, and most of us are familiar, but if you're new, yeah, that's where you can see what the company's about. And when we look at this chart, so, you know, it's up 3.7, but, you know, this 100-day moving average has been acting as a nice little trampoline, you know, a nice support level. It comes down, hits the tramp, little bounce, hits the tramp, little bounce, hits the tramp, little bounce. So far, this 100-day moving average has been acting as a support level. And it's continuing to rise. Now, what we saw here, though, was that we had a high, and this was lower high. And, you know, in technical analysis parlance, and I teach getting started with technical analysis on Tuesdays, which you're welcome to join. You know, it's bounced off this support level. So, but it could come up here and hit its head and roll over. And so maybe with this one, instead of doing a long call vertical where we may be in a little longer, maybe we just, on this one, we do a 1 ATR trade where we buy the call and we say, hey, in an average day, this thing moves about $2.04. And if you don't have ATR on your studies, you just come up here, edit studies, and, you know, start typing in ATR. Like, it's at the top of the alphabet. So it's right here. You would just add selected, and the default is 14. And, you know, there's usually a reason for a default. And so, like, as far as I'm concerned, if it ain't broke, don't fix it. So I have left that at 14. So that's how you add that. And if you want a more detailed description on what that means, just click the little question mark beside it and it will give you a detailed description. But so we're going to look at this and say, well, today's high, 79.82. So we're going to add 204 to that. So I'm going to change now my calculator to a scratch pad. Sorry, we're going to come down here. So this is Cisco. 1 ATR is 204. This is our example. Oh, CS, I skipped a C. And so we're going to say our target on this is going to be and I wrote these out ahead of time, 79.82 plus 204 is 81.86. So that's going to be our target. And if things do not go according to plan, because I don't care how brilliant you are at technical analysis or any of this stuff, there are going to be times when you have losing trades. And this could be one of them. So if it is one, what we don't want to lose is 100% of what we put in. So we want to know when we're getting out before we get in, whether the trade goes for us or against us. And if you've been following me for a while, you've heard me say this ad nauseum. So I'm sorry to be a broken record, but the beatings will continue until morale improves, right? So we're going to come down here. And again, with our 1 ATR strategy, it's like, does it trade more than 1 million shares a day? Check. If we come out to May, do we have volume here? Check. Can I buy an option for $5 or less? Because we don't want to risk more than $500. Now, if I come out here, we could buy 2 and we'd still be under that 500. So that's what we're going to do. We're going to do the first strike out of the money. And even though our delta is a little less, like here, we're paying twice as much, but we're getting 20 cents more. We're not getting, you know, the delta here means if the stock goes up by $1, the value of this option will go up by 62 cents. Here, the value of the option will go up by 41 cents, but it's 41 on 235 versus 62 on 5. Do you know what I'm saying? So percentage-wise, this is perhaps even more attractive. So we are going to buy, and we are actually going to do an OCO bracket, but I'm going to put it in this way. So we're going to buy a single, and we're going to buy 2. And then I'm going to come down to first trigger sequence, right click, opposite order. And this way, I'm going to make it a market order, good till canceled. And we're going to put in the target first. So our target, 81.86. 81.86. And less than 76.98. And this is one we manage daily. So if tomorrow this doesn't go up and hit our target, we're going to snug up the stop to 50% below the low of the close day on Tuesday. And so if you're saying, well, I'm going on a spring ski trip or I'm going golfing somewhere and I don't want to be looking at my trades for the next few days, then don't place this trade if you don't want to manage it. You know, like you have to agree to follow your rules. And if that's one of the rules, then, you know, like be honest with yourself about what you're doing. So this is a 1 1 ATR. And so that tells us now with a swing trade. So with this, I guess we typically with a swing trade, so the first trade we did, the buy right on APA. So we could have done that as a swing trade and bought a call and put this $45 as a target. So that would be a swing trade, a classic swing trade, right? And you know, we could do that along with the buy right and just compare them. You know, like we could come out here and say, well, let's come out to May on APA and we're going to do a swing trade here. We can do 2 of these. We've got lots of volume and then we'll compare it to the buy right. But with the 1 ATR, sometimes that's a strategy when there isn't a swing trade target in place. Okay, so we could do that. And with a swing trade, our exit is if we lose 50% of the value of the option, we put an exit in at a 50% loss. Now it could gap down, we could end up losing more. Yeah. Okay, so I wanted to show you one thing because it's time for us to wrap up. I always feel like I should be cueing Carol Burnett. I'm so glad we had this time together. I know some of you won't even know who Carol Burnett is, pretty old school, going back there, but so I've referred a lot to our example trading plans in this class. And so if you haven't subscribed to the Trader Talks channel, you're going to want to hit that button in the bottom right corner. You know, and what comes up first is whatever's currently being taught or what's coming up next. But if we come to playlists and come down, and I'm doing a lot of work on this playlist this week as it would turn out. And I put it into groups. So I've just created this as a folder. And so the first 13 of these are just very short videos. They range from kind of 2 to 5 minutes long on different candlestick patterns. So if you want a refresher on candlestick patterns, here you go. And they're in like little bite-sized snippets. So bet you can't watch just one. Then I've got these example trading plans. So today we did a long call vertical. And so here's an example trading plan. We exited a short put vertical. Here's an example trading plan. We did a buy right covered call. Here's an example trading plan. And then we did a long call with a 1 ATR target. This walks you through an example trading plan. So, you know, it covers like what to buy, when to buy, how much to buy, when to exit, both if the trade goes for you or against you, and then what are your routines. Okay. And then I added last week, for the first time in a long time, we had 6 trades that hit targets back in March within a week. And so rather than going through all the detail in class, I reviewed it and put it in this session here. So you can come here. I've also posted that on X, as I typically do. And I'm re-recording because back in a couple of years ago, I was getting a ton of questions on, like, how do you get your charts to look like that? How do you add a script? So a lot of these they've taken down and I'm redoing them because they had many, many thousands of views. So if you want to see, there will be a new refreshed version on the monitor tab coming up this week. I'll also post it on X. So guys, that's a wrap for today. One of the questions that often, or requests that often comes up in the surveys is, would you review what you did at the end of the class? So we placed 6 orders today and we did a long call with a 1 ATR target on Cisco. We did a long call vertical on NBIS. We did a buy right covered call on APA. So we did 3 different example stocks and 3 different example trading strategies. And then we did a review on our Iron Condor on UNH. We reviewed the profit and our return on risk on our bearish Tesla trade. We exited our short put vertical because it had hit our profit target on AMD, and we closed out the covered call on KMI, and we're waiting for a bounce. So I want to thank Kevin for being with us in the chat, to the guys behind the scenes for helping bring this class to life. Hit the like button. If you would do me a favor and do that, it helps move things up in the algorithms on YouTube so more people can find this content. It also sounds like applause to Kevin and I, so thanks in advance for that. Subscribe to the channel and follow Kevin and I on X, Kevin Horner CS, Barb Armstrong CS. You can also now find me on LinkedIn, so head over to LinkedIn and you can connect with me there. Thanks for being here, guys. Up next, Mr. James Boyd, so stay tuned. You won't want to miss it.